In the previous section, you learned the anatomy of a mortgage loan, how the promissory note creates the debt, how the mortgage or deed of trust pledges the property, and how principal, interest, points, term, and amortization all fit together. Now you will move one step earlier in the life of a loan, the moment a potential borrower sits down, fills out an application, and asks a lender for money. This stage is called initiating a mortgage loan. For most buyers, this is where their financing journey begins. They may have a general idea of what they can afford, but until a lender reviews their application and underwrites the loan, everything is only a rough estimate. As a real estate salesperson, you are not the lender's underwriter, but your clients will constantly ask you what to expect, whether they look like they will qualify, and why the lender is asking for so much documentation. Understanding the structure and purpose of the loan application and underwriting process will allow you to answer those questions calmly and accurately. The loan application, turning interest into action. The process of initiating a mortgage loan starts when the borrower completes a loan application and submits it with supporting documentation to the lender. Until that happens, a buyer is just a prospect. Once the lender has a completed application package, the file can move into underwriting, where the real decision is made. Most residential lenders use some version of the Uniform Residential Loan Application, often called the 1003, or just the application. This standardized form, developed by Fannie Mae and used throughout the industry, ensures that lenders collect consistent information about both the borrower and the property. While there may be minor formatting differences, the core information requested is the same almost everywhere, which makes it easier for lenders to sell loans on the secondary market. The application asks for several categories of information. It identifies the property being financed and whether the loan is for a purchase, refinance, or other purpose. It states the requested loan amount in basic loan terms. It gathers personal and financial details about the borrower, including employment history, income, assets, debts, and housing history. It also includes questions about citizenship or residency status, marital status where permitted by law, and whether the borrower has any outstanding judgments, bankruptcies, or foreclosures. In addition to the form itself, the borrower must submit supporting documentation. A salaried borrower might provide recent pay stubs, W-2 forms, tax returns, bank statements, a copy of the purchase contract, and evidence of earnest money. A self-employed borrower might add business tax returns, profit and loss statements, or corporate documents. All of this documentation allows the lender to verify that what is written on the application matches reality. The application must be complete, signed, and dated before the lender can meaningfully evaluate it. The initiation of the process occurs when the lender receives this completed package. Federal law requires lenders to accept applications and then give the applicant timely notice about the status or disposition of the application, such as approval, denial, or a request for additional information. If a borrower provides fraudulent information and the lender later discovers it, the borrower may lose any fees paid and may even face legal consequences. This is why you should never encourage a client to round up or smooth over information. Accuracy is critical. Imagine a couple, Emma and Carlos, who want to buy their first home. They meet with a loan officer who walks them through the Uniform Residential Loan Application. Together, they list their current jobs, their salaries, their savings, their car loans, and their student loan debts. They provide pay stubs and bank statements. They sign and date the application. At that moment, their file is ready to move into the lender's next phase: underwriting, mortgage loan, underwriting, measuring risk. Once the application is received, the lender's underwriting department takes over. Underwriting is the process of assessing the lender's risk in making the loan. Lenders are not simply asking, "Do we like this borrower?" but rather, what is the probability that this borrower will pay us back as agreed? And if something goes wrong, Will the property be adequate collateral to cover our loss? Mortgage underwriting has three main tasks. First, it evaluates the borrower's ability and willingness to repay the loan. Second, it analyzes the value and marketability of the property offered as security. Third, it determines the appropriate loan terms and conditions, such as required down payment, interest rate adjustments, and any need for mortgage insurance. Every loan involves risk. A borrower might lose a job, experience illness, or incur other debts and default on payments. A property might be damaged or might decline in value due to market conditions or neighborhood changes. In a worst-case scenario, the lender may have to foreclose and sell the property, only to discover that the sale proceeds are not enough to cover the unpaid balance, costs, and fees. The underwriter's job is to minimize the likelihood and impact of these risks by applying the lender's guidelines to each file, qualifying the borrower, ability and willingness to repay. To qualify a borrower, an underwriter examines several broad areas: income, cash resources, credit history, debts, net worth, and employment stability. Together, these factors create a picture of the borrower's capacity and character from a lending standpoint. Income is evaluated not only in terms of amount, but also in terms of stability and likelihood of continuance. A long-term salaried position in the same field for several years is often treated as more stable than a brand new job or commission-only position. The underwriter will calculate income according to internal rules, which might average overtime, bonuses, or commission earnings over a certain period, or discount income that appears temporary. Cash resources include savings, checking balances, gifts from family, and other liquid assets available for the down payment, closing costs, and reserves. Lenders want to see that the borrower can handle not only the initial costs of the purchase, but also unexpected expenses after closing. In some programs, reserves equal to several months of mortgage payments are required. Creditworthiness is assessed by reviewing the borrower's credit report and credit scores. The underwriter looks at how much the borrower currently owes, whether payments have been made on time, how long accounts have been open, and whether there are any collections, judgments, or bankruptcies. A strong credit history suggests the borrower is likely to handle new obligations responsibly. A troubled history does not automatically disqualify a borrower, but it may trigger additional conditions, such as higher down payments or stricter documentation requirements. Debt and net worth are used to compute ratios that compare the borrower's income to their debt load. These debt-to-income ratios help the lender determine whether the borrower can reasonably handle the monthly mortgage payment in addition to existing obligations. Employment stability is also important. Frequent job changes without clear advancement or gaps in employment may raise concerns for the underwriter. As an example, consider Marcus, who applies for a loan to buy a townhouse. He has worked for the same employer for 5 years, earns a steady salary, pays his credit cards on time, and has modest car payments. His debt-to-income ratios fall well within the lender's guidelines. His savings account shows enough funds for a 10% down payment, closing costs, and several months of reserves. From a borrower qualification standpoint, Marcus looks strong, qualifying the property, loan-to-value, and collateral strength. Even if the borrower appears solid, the property itself must also qualify. The lender is not just lending to a person, it is lending against a specific piece of real estate. To assess this collateral, the lender orders an appraisal to determine the property's market value. The underwriter then compares the requested loan amount to that value. The relationship between the loan amount and the property's appraised value, expressed as a percentage, is called the loan-to-value ratio, or LTV. This is a key measure of risk. The higher the LTV, the less equity the borrower has in the property and the greater the lender's risk of loss if the borrower defaults and the property must be sold. If a home appraises at $100,000 and the lender's guideline is to lend up to 80% of value, the maximum loan would be $80,000. The borrower must provide the remaining $20,000 as a down payment, plus closing costs. That 20% equity cushion lowers the lender's risk. It means that if the lender forecloses and sells the property for approximately market value, there is a good chance the sale proceeds will cover the loan balance and expenses. In practice, lenders use a range of LTVs based on the loan program, borrower profile, and market conditions. Some conventional programs might go as high as 95% or more with compensating factors, while government-insured loans may allow even higher LTVs under certain conditions. However, as LTV rises, lenders typically require additional protection. Imagine a buyer, Sarah, who wants to purchase a $200,000 home with only $10,000 down. Her requested loan amount is $190,000. The LTV is 95%. From the lender's perspective, Sarah has very little equity at closing. If property values decline even slightly, the loan could become larger than the property's value. To offset this risk, the lender may approve the loan but require mortgage insurance. Private mortgage insurance and high LTV loans, even if both borrower and property meet basic guidelines. A lender may still feel exposed to loss when the down payment is small and the loan-to-value ratio is high. In these cases, the lender may require the borrower to obtain private mortgage insurance, commonly called PMI, on conventional loans. For certain government loans, a similar protection is provided through government insurance or guarantees. Mortgage insurance is not designed to protect the borrower. It protects the lender against loss if the borrower defaults and the foreclosure sale does not fully repay the loan. The borrower pays the insurance premiums, which can be structured as an upfront payment, monthly payments, or a combination of both. In return, the lender is willing to approve a higher LTV loan than it otherwise would. For example, Sarah's 95% LTV loan might be approved with the condition that she pay monthly PMI. If she later pays down the loan, or if the property appreciates to the point that her equity reaches a certain threshold, she may be able to request removal of PMI under applicable rules. As an agent, you do not set PMI requirements, but you should understand why a buyer with a small down payment might see a mortgage insurance line added to their estimated monthly payment and closing disclosures. Review summary. In this section, you moved from understanding how a mortgage loan is structured to understanding how it is actually initiated and evaluated. You learned that the process begins with a formal loan application, usually on a standardized, uniform residential loan application form. The application must be complete, signed, and supported by documentation that verifies the borrower's income, assets, debts, and other key facts. Once the lender receives this completed package, the file moves into underwriting. You then examined underwriting as a systematic assessment of risk. The lender evaluates the borrower's ability and willingness to repay by analyzing income, cash resources, credit history, debt levels, employment stability, and overall financial strength. At the same time, the lender qualifies the property by ordering an appraisal and comparing the requested loan amount to the appraised value. This comparison is expressed as a loan-to-value ratio, which is a central measure of risk and a key driver of required down payments. Finally, you saw how high loan-to-value ratios can trigger the need for mortgage insurance, even when both borrower and property meet guidelines. A small down payment increases the lender's risk of loss if values decline or a foreclosure is necessary. Mortgage insurance allows lenders to approve higher LTV loans by shifting part of that risk to an insurer, though the cost is borne by the borrower. Together, these concepts explain why some buyers sail through underwriting, others face extra conditions, and still others must adjust their plans before they can obtain a loan. Discussion. Question 1. Why does a lender require so much documentation to support the loan application, instead of simply trusting the information the borrower writes on the form answer? lenders are managing large financial risks and must comply with strict regulatory and investor requirements. Documentation allows them to verify that income, assets, debts, and other details are accurate, which reduces the chance of fraud and helps ensure that loans meet secondary market standards. Verified information is essential for assessing whether the borrower can realistically repay and for protecting the lender and investors who may later purchase the loan. Question 2. How does the loan-to-value ratio connect the appraisal you learned about in the previous chapter to the underwriting decisions in this chapter? Answer. The appraisal establishes an estimate of market value. The lender then compares the requested loan amount to that value to calculate the LTV ratio. A lower LTV means more borrower equity and lower risk for the lender. A higher LTV means less equity and higher risk. Thus, the appraisal directly influences how much a lender is willing to lend, what down payment is required, and whether mortgage insurance will be needed. Question 3. In what ways can understanding underwriting help you manage a buyer's expectations during the home search? Answer. If you understand how underwriters look at income, debts, credit, and LTV, you can help buyers focus on properties that fit their likely loan approval range. You can encourage them to get pre-qualified or pre-approved before shopping. Explain why certain documentation will be requested, and prepare them for possible conditions, such as paying off small debts or providing extra proof of income. This reduces surprises and emotional stress later in the process. Question 4. Why might a buyer with a small down payment still be able to obtain financing, even though their loan-to-value ratio is high? Answer. A high LTV increases risk to the lender, but mortgage insurance helps offset that risk by covering some of the lender's loss in the event of default and foreclosure. Because this safety net exists, lenders can approve higher LTV loans than they would otherwise tolerate. The buyer pays for the insurance, but in exchange, they gain access to financing without waiting years to save a large down payment. Closing remarks. Initiating a mortgage loan is much more than filling in a form and waiting for a yes or no. It is a coordinated process in which the borrower's financial story and the property's value story are brought together and tested against the lender's risk standards. As a real estate professional in today's market, you stand at the crossroads of these stories. When you understand how applications are evaluated, why documentation matters, and how the loan-to-value ratio drives both down payment and mortgage insurance decisions, you become a more effective guide for your clients. In the sections that follow, you will see how different loan products and programs fit into this framework. Whether the loan is conventional, government-insured, fixed-rate, adjustable, or tailored to a special purpose, the same basic logic applies. Collect accurate information, evaluate risk, protect both lender and borrower, and design loan terms that make sense in light of market value and the borrower's capacity to repay.